Hello everyone and welcome back to another session for retail traders called the Fibonacci Retracements. So today in this retail traders session we are just covering yet another technical analysis related topic which is related to a tool which has been widely used by technical analysts, and it is a little bit of mystery, a little bit of answers, but in today's session we are going to decode all of that. We're going to discuss what it is, we're going to discuss its significance, why is it so popular in the field of technical analysis, we're going to see some practical examples of it, and then we're going to see also what are the advantages and disadvantages of using this tool, and also conclude with basically how much should you actually lean on this tool in your day-to-day analysis. So without much delay, let's get started. Application-based approach to Fibonacci retracements. Now, let me remind you one thing, that the Retail Traders series is a series which is dedicated to helping retail traders learn about different topics within the field of technical analysis, not from a theoretical perspective because the internet has enough material to help you cover that on your own, but from a more application and practical perspective. So all of these highlighted topics have already been covered and the videos are already available in our archives. All you have to do is go into the live section of the playlist. So we started off with volume analysis around 6-7 weeks back, and we had a huge success with that. We got very positive response because of the discussion that was done leading into the relationship between price and volume, and how volume can help us identify trend reversals and trend continuations more effectively. Then we moved on to the discussion of price patterns, support resistance levels, and moving averages. We combined those two sessions together. We covered technical indicators, and today here we are talking about Fibonacci retracements. All right, so let's get started with the session. I'm going to walk you through the introduction. I'm going to give you some examples, and once you're done with the session, at the end, I'm also going to spend around 15 minutes answering your questions about different stocks, about this topic. So if you have any questions about the concepts that I'm going to discuss, feel free to drop a comment right away, and as soon as I am done with my presentation, I will move over to your comment and help resolve your query. All right. So I'll just take a quick look. All right, everything looks to be working pretty smoothly for us. All right. Now, introduction to Fibonacci retracements. What is Fibonacci retracement? At the core, it is nothing but a mathematical sequence. It has a very distinct property that the sequence follows these rules. Every number is the sum of the two previous preceding numbers. So for example, the series begins with 1, 1, 1, 2, 3, 5, 8, 13. So this is the first mathematical property of this Fibonacci sequence, and it is very important to know these basic definitions because the golden ratio, which I'm going to tell you about briefly, comes out of this very sequence. So now that you know that this sequence is nothing but a very natural progression and each new number comes from adding the two subsequent numbers, it also means that the sequence is never ending like most sequences. Now, as each number progresses or as the sequence grows, the ratio between each number, may it be the number subsequent, may it be the number before, or may it be the number after the every number, there is a certain ratio and that ratio remains constant, and that is where the beauty of the Fibonacci sequence lies. So this was actually, the sequence was discovered, not actually discovered, it was popularized by a mathematician called Fibonacci, who had come to India and the Arabic nations to learn a lot about mathematics. So the official name which he had given to the sequence had something to do with, he had named it local name which, which told people that he got it from India. So that is actually where the Fibonacci sequence emerged. It is within India. It got the name Fibonacci because of the mathematician who popularized the concept, the sequence. Now, so we said that each subsequent number grows and they all tend towards a unique ratio. This ratio is the ratio that is commonly found across nature's creations, from the smallest of galaxies to from the smallest of atoms to the largest of galaxies. Okay, this constant ratio has been observed across nature's creation, and the financial markets are not the financial markets have not escaped, and why, we will talk about that in a bit. But first, more about the Fibonacci sequence. So basically, if you look at this drawing is the perfect representation of what the Fibonacci sequence means. Now, if you look into this drawing itself and you look at these quadrants, these triangular shaped quadrants, now if you see every single quadrant which is one size or one step lower than the previous one has a very specific ratio, right? And this way, if you continue going, you will keep going on. This very sequence or this very pattern can go infinitely, correct? The more you look into the pattern, the more you can keep drawing. And similarly, the bigger you want to expand the pattern, it can infinitely keep on expanding, because every time the next curve and the next quadrant will be exactly 1.618 times of the previous one. You can see here clearly this big quadrant is 1.618 times of the smaller one. Now, if you see, there is a lot of similarity between the different shapes that I have put together for you. So from the way the shells are formed to the way, like in any beehive, if you divide the number of male bees to the female bees, that ratio tends towards 1.618. Then the way the seeds on a sunflower, the way they are arranged and the way they move out from the center towards outside, the arrangement of that is also in the ratio of 1.618. The way a succulent grows, the way the pine cone unravels. In fact, even the way a tiny little snowflake starts growing, the repetition of this nature, the repetition of any pattern into bigger and bigger sequences, it's called a function of it has a name. It's called fractalism. It's called something being a fractal, where a smaller form continues to repeat itself to form bigger forms, bigger and bigger forms. So for instance, I showed you this drawing, right? In this drawings, it is the same tiny quadrant which is then becoming a bigger quadrant, which is then becoming a bigger quadrant, and all of these quadrants together are also coming together to form bigger and bigger, like, lay the groundwork for bigger quadrants to be formed. Like in this shell, you can see it, the compartments that are there right in the center are tiny, but then those tiny compartments have an exact ratio relationship to the bigger compartments and keep getting bigger. Now, why am I emphasizing this so much? You've already gotten the point that, okay, fine, there is a certain nature, there's a certain ratio, and that ratio can be experienced everywhere across the universe. Because when we go into the markets, we see the same thing happening. For instance, take a look at this image. In this image, you can see that there is a up wave, a down wave, and an up wave, right? Now, in each of this up wave and down wave, if you go into it, you will be able to capture more wave breakdowns. Now, if you go one step lower, you can see that the initial one wave, which was broken into three waves, has now been broken into 1, 2, 3, 4, 5, 6, 7, 8, 9 waves. And if you go one step lower, you will again be able to count many more waves within the same wave formation. This nature in financial markets and price fluctuation, it's also called fractals, right? And all of these price movements or all these jagged lines that you see, each and single every one of those tiny lines forms a trend. Now it is upon you to decide which trend do you want to trade. Let's take another example. Now I'm going to need you to input, okay? I'm going to need you to give me some input. Starting from the left hand side, right? Starting from the left hand side and going down, I want you to take a guess at which time frame might be which image might be which time frame. So if you could just, so for instance, if you think this number 1 might be the daily time frame, right? 1D. If you think this second one might be the hourly, put in that. So what do you think, or what do you think about all of these images? Do they belong to the same time frame? Do they belong to the second time frame? Even if you don't write it in the comment, I want you to really look at these images and think to yourself. The only common thing between all of these images is that I have covered 1000 candles in all these images. I need you to look at them and tell me what are you able to tell them about what time frame, what time period do these candles cover. All right. Now I hope you have formed an opinion for yourself about what different time frame these cover, so I can now reveal the answers to you. As you can see, the trend exists across all the different time frames, starting from the weekly time frame to the daily time frame to the 75-minute time frame to the 15-minute or the 3-minute. The trend exists across the board. However, the smaller the time frame you go, the more violent the trend, the more movement in the trend. Like I said, last 1000 candles across all. In the weekly time frame, you can see that the trend becomes a lot clearer. Why? Because there are lots and lots of tiny little trends which have gone into forming this entire trend, right? So it is a lot more reliable. So this is the reason why people say that, you know, if you want to succeed in the market consistently, just put your money in an index fund. And in fact, for people who are starting off in the market, putting money in the index fund is the best idea because of this. While you continue to learn and garner more knowledge in the market, the index fund will protect your money and give you the necessary stock market exposure that you need to learn. Next, if you look at the daily time frame, here also the trend is pretty well visible, right? It's consistently upward, as we can see. And if you also notice, this 1000 candles of the daily time frame is only this tiny little part of the weekly time frame, only the end part of the weekly time frame. Both are 1000 candles, but our perspective has shifted now from lifetime movement, and most of you might have also recognized that this is a chart of Nifty. Just covering 1000 candles, our perspective has moved from a huge time frame on the chart of almost a lifetime of movement on the chart of Nifty to a very small post-COVID section of Nifty only, right? Now, coming to the 75-minute time frame. Now, the 75-minute time frame is again only 1/5 of the time frame that of the price movement that you're seeing on the daily time frame. Even on the 75-minute time frame, you can clearly see that the trend is still very intact. There are a lot of movements in this. The noise, as we like to call it, is a lot louder here, but there is still a very good tradable trend here. So for people who prefer to do swing trading, the 75-minute time frame is therefore a very suitable time frame for them. What happens when you start going lower, or when you start looking at more details into the price activity, into more smaller and smaller time frame, is that the level of noise increases. Why is this problematic though, and what does it have to do with Fibonacci retracements? See, the answer is simple. The smaller you go, the amount of noise increases, the amount of reliability decreases. Now, even in the Fibonacci retracement, even in the Fibonacci sequence that I was telling you about, I told you that every number tends towards a unique ratio as they grow, but not when they are very small. So the numbers that you can see right now, if you start doing them on a, if you start calculating them like 3 divided by 2 or 5 divided by 3 or 8 divided by 5 or 5 divided by 8 or 13 divided by 8, you will see that these numbers are still very far away from 1.618. What this explains is that when the sequence is very small, or when we are looking at very small numbers or a beginning of the development of this fractal nature, we are basically giving in or taking into too much noise, right? And as a result of that, the level of predictability reduces in the stock market also, right? And the logic for that also comes from the Fibonacci ratio. Now see, there are lots of different names, there are lots of different theories to support the same mathematics. You talk about the Dow theory, or you talk about the, so in the Dow theory, there is the concept of different degrees of waves. In Elliott waves, uh, there is again the concept of different degrees of waves, different waves, the impulse wave, the impulsive, the correctionary wave, and within those also there are sub waves. There are more than 7 different uh, waves types which have been identified in the Elliott waves, which is nothing but it starts from the minor or absolutely the minute waves which start from, you know, your tick chart, and they go up all the way to the primary waves, which is studied on things like the monthly or the weekly time frame. So different analysts or different researchers have given the same phenomena different names, and a lot of people tend to get lost in definitions. What really matters is the logic behind what we are seeing. So now some of you might also have the question that, you know, why is Fibonacci retracements, or why are the Fibonacci numbers visible in the stock market or any financial market for that matter, right? So when I'm talking about any concept of technical analysis, you might already know that it does not only apply to the stock market, but it applies also to any security or any financial security which has live trading data, and it can be plotted on a chart. May it be commodities, may it be currencies, everything. They all work with the same application of technical analysis. It's just the principles remain the same. It's just the practice changes a little bit. You know, just how within stocks also the way stocks might respond, or the way indicators. Sound test. All right, that seems to be back. Uh, is it going to be unreliable for us today? All right, so let me just check back on the other one too. Do we have a sound problem? Sound check. Okay, that seems to be fine too. All right, guys, we are back with the audio. I hope I did not move along too fast. I was just explaining, as you might have also seen on the charts, that we basically have fractals unfolding here. So I will go back on the 15-minute time frame in this chart itself and help you see. Right? Um, this should be audible for the YouTube folks, and we've gotten mute here. Let's check it out. Okay, the sound is good on this as well. Let me just give a quick reminder. All right, let's continue with the session. All right, so like I was saying, smaller waves come together to form bigger waves, come together to form still bigger waves. For you to be successful, you need to determine which is the wave that firstly you are going to trade with. So see, in the stock market, there is absolutely no lack of opportunities. Okay. In fact, there is an overwhelming number of opportunities to trade in. You have to be very selective about which opportunities are the one that you are going to dedicate your energy into seeing. Because if you start participating into everything that is thrown in your way, you will end up exhausting yourself. You will end up deploying your you will end up spreading your resources thinner than you intend to spread them, and that will not lead to consistent success. So in the stock market, it's not about doing more, it's about doing less with more efficiency. Okay, so I'll give you my example, right? So I am a swing trader, a full-time swing trader. I turned full-time 3 years ago, but I've been studying the market for nearly 10 years now, right? More than 10 years now. After a lot of trial and error, I understood that the daily time frame was a little bit too slow for me, because I could see clear trends forming within the 75-minute time frame, like I'm marking here. And I understood that if I can properly learn how to harvest these 75-minute time frames, then I can put myself in a position to not only beat the market, but beat the market, the 16% average returns that the market is giving right now, beat that with many, many times more returns. All I had to do was properly apply my skills to learn the entries and exits on the 75-minute time frame, and take confirmations from one time frame higher, which is the daily time frame, one time frame lower, that is the 15-minute time frame. Okay, now so that is the 75-minute time frame for me, and this has been serving me, not just me, very well, but also my subscribers. So I give swing trading subscriptions, right, through Telegram channels, and people who have been associated with me and leaning on my trade setups have also been benefiting significantly from those.
Okay, so why not 15-minute time frame, right? As you can see that in the 15-minute time frame, like there are still smaller waves than the 75-minute time frame also. But if you try to plot these smaller waves, which are basically, formed on one lower time frame, you will see that they don't have a very well-defined structure. They can be small, they can be big, they lack something that is very important to succeed. They lack a consistent structure. They can be very long at sometimes and very short at sometimes, and that is the reason why 15-minute time frame and lower time frames become too volatile to trade successfully and make money consistently in the market. Now, how do Fibonacci ratios come into play here? So firstly, how do you draw the Fibonacci ratio? So this layout that you're seeing is nothing but the trading view layout. Now within the trading view layout, you get on your left side this drawing panel. Correct. Now you have to click on this drawing panel, and on the arrow you can see Fibonacci retracements is the first drawing tool. There is a keyboard shortcut also. If you simply press Alt F, you will automatically have selected the Fibonacci drawing tool. Now, how the Fibonacci drawing tool is basically drawn is always from left to right. So whether you want to measure the retracement of a up wave or a down wave will simply depend on which is the trend which has gone latest, ended the last. So for instance, suppose this is the trend that we are seeing right now, right? So the market has gone up. Now if you want to know what are the potential key levels for the market coming in the coming sessions, then what you're going to do is, I'm going to show you that again. You're going to start from the base of the trend. Now for this latest uptrend, we can see clearly that this is where the base is, right? Irrespective of whether you start the base from here or here, it doesn't matter because they are almost at the same level, right? So you're going to make the first click here, stretch the Fibonacci retracement all the way to the top. Now there are different school of thoughts about whether this wick should be a part of the Fibonacci retracement or should it end at the body itself on whichever time frame you are drawing. My personal opinion is it does not matter. In the stock market, you can never be very exact with your analysis. So it does not matter wasting your time on few fractions of points. Okay. So here then, and also if you see my levels on Nifty, I usually round it up by 20-25 points. Okay, because again, like I said, getting into too minute details makes no sense for anybody. Moving on. So we have drawn the Fibonacci retracements. So within the settings of the Fibonacci, you have the option of basically making it either look like percentages or look like numbers. So I prefer that my retracements, they look like ratios. I don't prefer them to look like numbers. So basically, 0.618 stands for a 61.8% retracement level. 0.5 stands for 50% retracement level. What does that mean in application? So suppose if the price starts coming down here, then when the price reaches around this 0.5 line, this is basically where it would be the 50. This is where the decline in price will have retraced half of this uptrend. So that is called 50% retracement. Why is 50% significant? Why is 61.8% significant? Or rather, why are these five ratios, these actually 7 ratios that are marked, including 0 and 100%, why are they significant? Because these are basically multiples or fractions of the golden ratio, which is 61.8%, right? Now, as you can see, the Fibonacci retracement, the ratio, it extends also beyond the 0 and the 1. So how this extension basically helps is when the stock market moves into a new category or a new territory. Like for instance, Nifty is Nifty is at the lifetime high, right? So now we don't have any historical prices to help us determine any potential resistance zones. So drawing this Fibonacci retracement level is now giving us potential zones of retracement into virgin territory. So like 20,800 as per the extension of this most recent upwave becomes a very good very good resistance level, right? And above 20,800 there is again then the level of 21,360. All right, so that is one good application of Fibonacci. Now, how reliable is that? It is not very reliable. Okay, this is basically Fibonacci retracement is not a tool that you use for trading. It should at no point be the primary trading decision maker for you. Fibonacci drawing tool is a very good tool as a evidence marker or evidence collector. So if you have attended my previous sessions on the retail trader special, you know that I always talk about never ever letting one indicator or one observation be the reason why you go ahead and commit your capital. You need to collect evidences. And doing this Fibonacci retracement drawing or the drawing the Fibonacci retracement can help add to another evidence. Okay, so for that, let's just move one more step lower. For instance, when this entire wave had played out and the correction began, you can see that the correction stopped exactly at the 50% mark and it started to go up. So usually what is observed is that when the bull market or a uptrend, when a trend is very strong, it usually does not retrace more than 61.8% of the entire trend. Okay, so a lot of times if you're confident that the uptrend is strong in motion, your indicators, your momentum indicators are strong, you have good chart pattern observation, volume analysis is helping, you have say a bunch of other trend line support is there, you have a bunch of other supports or evidences indicating that the uptrend is intact and expected to continue strongly. In that case, if the prices come down to the level of 50% or 61.8%, then that becomes a very good buy on dips opportunity for you. And this applies both ways. It applies in bullish scenario also, it applies in bearish scenario as well. Okay, so all right, this is one exercise that should actually be performed by you on as many different instruments and on as many different time frames as you can, because it will really help you gain insights into how the market responds to this golden ratio in different conditions, right? So for instance, if you see here, this retracement that I have just drawn, this is the point where the market had topped out for a while, right? Around the level of 18,600, 21st of October, right? And then a complex triangular correction had started in the market, and this correction took the market all the way to 78.6%. Now 78.6% was a pretty deep correction, and this threw off a lot of people, because what you can see is that 61.8% correction was met twice in the market, right? You can see it was here twice. The price took support twice, gave a breach, went down almost to the 76.8, did not touch it entirely, and then the market shot up. So this is how a lot of people's stop losses also get triggered. So when they see a correction starting, a lot of people, what they'll do is they'll go ahead and they'll place the stop loss somewhere between the 61.8 and 78.6% Fibonacci retracement level. But the market will go just below that to trigger all of those stop losses and then shoot up. You call it market manipulation or you call it overusing of any tool. See, the stock market has a tendency of cancelling out a set of mindset or an observation that too many people start to apply. Okay, so this is the reason also why I told you that Fibonacci retracement is a great tool to keep in your back pocket when you need to add more, if you need to add more evidences to your cluster of existing evidences, but it should never be the first point, or it should not be the starter of the discussion that should I commit my capital to a particular stock or not. Because see, if you use something as weak as Fibonacci to commit your capital, you automatically start working with a bias. So the first evidence which nudges you towards committing capital, may it be to a long side or a short side, it should be a very strong evidence, and then that evidence can be backed by things like trend line support resistance, it can be horizontal support resistance zones, it can be moving averages, it can be Fibonacci tools, it can be many other things, okay, chart patterns and so on and so forth. So usually things like technical indicators, chart patterns, or even major trend line support and resistances should be the beginning point of your investigation into whether you want to commit your capital or not. Fibonacci is a great tool, but it should not be the front runner of your analysis methods. It's actually a very fun exercise to keep drawing these Fibonacci retracements, because the consistency or the number of times you will see price perfectly turning away from the 61.8% is quite baffling. It does take you into a surge of overconfidence for this drawing tool, but then you also notice instances like this where the 61.8% was just breached enough to capture as many stop losses as it could, and then go back, the price continues the trend. It's very interesting phenomena and it's very interesting observations. So even though I might have said a few incriminating things about the usage of Fibonacci retracement, I do use Fibonacci in my own analysis also, but it's part of the hygiene check and the position management rather than part of creating new positions. Okay, so your analysis, your approach to the market changes also significantly when you are debating whether you should create a new position versus when you have created a position and you want to manage that position. The analysis also needs to change depending on whether you are at the beginning of a trend or towards the end of a trend. So like here you can see in the beginning of the trend, the market moved up quite significantly, right? Because this was a strong start. So sometimes the market can a new trend can start very sharply also. Sometimes it can also start with a little bit of a slow momentum. So this is basically what we call a rounding bottom, right? And then this is the sharp turn can sometimes be part of a formation like a double bottom. So ultimately, these are all different names, different phenomena of the market, because the market does not behave the same way at all times. You just have to approach things in a more logical manner. So going back to our chart, to our presentation, like I was saying, the potential reversal zones can be identified in advance, but there is no guarantee. Fibonacci retracements add weight to our existing cluster of evidence. It does good as a secondary tool, not as a primary tool. It is best used in complement with other tools and indicators. 61.8% is one of the best reversal zones, closely followed by the 50% retracement zone. Sometimes the other flanking zones are also very effective. The other flanking zones would be your 38.2%, which is basically the half of 61.8%, and the 78.6% is also a good retracement zone that has been observed. Some of the drawbacks of the Fibonacci retracement tool is that it can be subjective, because who is starting the Fibonacci retracement from what starting point and ending where can significantly change the outlook of your key support resistance zones. So there is a lot of subjectivity involved there. There is no causal link. So if, like I told you, I just told you about the resistance, potential resistance at 20,800. All I have to support that resistance zone right now on the chart was the Fibonacci. I don't have any other cause to link with that resistance zone. So that makes it less reliable. That is the reason why I said I wouldn't use Fibonacci as a primary decision making tool, but as a secondary confirmation tool. There can be overlaps of levels. So if you start marking Fibonacci across all the waves that happen, you will see there are lots of overlapping levels, which is actually not a drawback. It is actually a strength also, because when there are overlapping levels, they tend to be stronger reversal zones, and around those overlapping levels, traps happen less often. You know why? Because a lot of people are looking at this particular level for a lot of different reasons, lots of different drawn retracements, and as a result, more participation comes in here. So there is a bit of a self-fulfilling prophecy also which happens here. But irrespective of that, the overlapping of levels makes for stronger levels. Okay, and then there is also a lack of universality, in the sense that what are the levels that you are using? Somebody else might be using more broken down levels. Someone might also be using slightly different levels. Some people also use Fibonacci for extensions, like I said, beyond the all-time highs. Some people only like to use it for retracement. So the application is more personalized in this case. So if you are enthusiastic about technical analysis, and if you've been hearing about the Fibonacci retracement but think it's been a mystery to you, the best way to decode that mystery is, firstly, keep in mind the pointers that I have given to you, and secondly, go get your hands dirty, draw some lines, draw some retracement levels, and see for yourself what your primary stocks of interest, how they respond with this amazing tool. Cool. So with this, we've come to an end of our today's session. I will take 15 minutes now to look at the comments and help you out with your queries. I hope the session was beneficial to you. All right, so today I see the market is off. So I always feel like when I do a session on these off days, I get a lot more attentive audience, because they're not distracted by live prices or what happened in the market today. All right. I see some. All right, let's see. So Ajit is asking if he can see the video later. Yes, Ajit, you can see the video later. I will drop the link to see it later in the comments for you. And okay, this is working. So all my recordings are always mentioned on my YouTube. So you can watch it there. And if you're watching this on the Economic Times, then also the videos are always archived. So you can check it out there also. Let's see. Are there any comments related to our session today? Lots of people commented about the mute. I am very sorry about the audio. Yes, my mic died in the middle of the session. All right. Let's see. Let's also check out on YouTube. Fibonacci. So Vinay Single G has an opinion that Fibonacci can only be used for active position management. See, it is not that it can only be used for that. It can act as evidence when you want to make fresh positions, especially when you're trying to capture a trend continuation. Right? So if you're trying to capture a trend continuation, you've already missed the first leg of uptrend. You want to optimize your entry, not enter after a rally, but maybe catch the stock more after a dip. Then the Fibonacci can help you give a zone. You can say that, okay, when the stock reaches around, say, 38.2% retracement to 78.6% retracement, that is maybe when I will start accumulating the stock, and then you can set your stop loss below the recent low. Basically, if the entire wave gets if the previous impulse waves or the previous up leg gets 100% retraced, that is that's the official sign of trend reversal, right? Having a lower low. If that happens, in that case you exit the position, you take your stop loss. Okay. So Arun Kumarji is asking, can this be used for resistance and support? So yes, Fibonacci can be used for resistance and support, but it's not very reliable. Like I said, there are a lot of instances of, big cats or sharks are also using the tools that you're using. They know what tools you're using. They know your mindset better than you know your mindset. Okay. So relying too heavily on Fibonacci is not a very good idea. And this can be seen a lot actually in Nifty trading, where intraday traders try to use or rely heavily on 61.8% reversal level, and that level gets butchered really badly in the options trading. So if you're an intraday trader, then I would advise you don't do intraday trading at all, because that entire landscape is designed to take your money away. Okay, it is not beneficial for you, no matter how lucrative it is showcased to be. It really is not. Okay, because there are very limited applications that you can do. There is too much noise that you have to deal with, and all of those things don't really serve you to become successful. Okay. So DV is asking, other tools with Fibonacci for swing trading suggest. So DV, if you just saw the first slide which I had shown, I will share my screen again. So basically all these tools that you're seeing, these are all very suitable for so these are actually not substitutes. These are all supplementary, in the sense that when I am determining where I should put my capital next, I am looking at all of these tools and all of these different analysis methods. I'm looking at volume analysis, price pattern, support, resistance, the technical indicators which I am following. Moving average plays multiple roles, horizontal key zones, candlestick patterns unfolding, trend lines, volatility of the market, of the sectors, industries, different, and all of these analysis across different time frames. Okay, so it's not that you have to do the analysis only on 75-minute time frame. You have to do all the analysis across all the different time frames. Okay. Let's see. So we have Shyam. So Shyam's Jadodia's got a question. So he's realized that in Nifty intraday trading on the 15-minute time frame, once the candle has closed above 0.236, that is 23.6% retracement level, it tends to retrace until the 61.8%. So basically what he's saying is, if it has gone below 23.6% retracement. It will retrace until 61.8. Can this be used as a trading strategy? So see, my friend, it can be used as a trading strategy. What you're defining is a trading strategy. But what is the cost of the strategy? What is your risk reward ratio of the strategy? As I said, these Fibonacci levels are subjective. Okay, they are not universal, they are not exact, they're not a rule of thumb. If you're talking about intraday trading, it means even a 10% move against you is going to hurt you, right? And for Nifty, a 10-20% move is nothing. Okay, 10-20 point move is nothing. So in that situation, I am not a intraday trading expert. What you are suggesting is a viable strategy, but I wouldn't say the risk reward ratio would be sufficient enough for you to commit your capital. My personal opinion is that you should never go ahead and commit your capital until and unless the risk reward ratio on any trade is minimum of 3, right? In this case, I highly doubt you are going to get that. So that is that. Let's take a final look. All right. So I think we have come to the end of this session officially. Okay, one last question just popped in from Praveen. Which time frame is best for swing trading or positional one, and time frame for long-term holding? Okay, so Praveen, I prefer to use the 75-minute time frame. The 75-minute time frame is basically it breaks down one entire day of trading into 5 neat candles. I don't prefer to use the hourly time frame, and I don't recommend using the hourly time frame to people because there is always that residual candle of 15 minutes, which can sometimes be a little misguiding, which can, look like a doji, even though it is not. Right? And I take dojis pretty seriously on charts. So I don't like to see incomplete candles posing as dojis on my chart. So that is the reason I use a 75-minute time frame. Now, 75-minute time frame is basically the primary decision maker for me, but I will also refer to the one time frame higher and one time frame lower to back up my decisions formed on the basis of the 75-minute time frame. So this is for positional or swing trading. I like to hold my trades anything between 2 weeks to 6 weeks, and it does pretty good for me. I'm able to capture great trends. In fact, if you would like to know more about it, feel free to join my Telegram channel because I've been swing trading quite a bit with very enthusiastic and well-learned people. I'm going to drop this link for you in the chat also if you're interested. I'm just calling it TG, and you can click on the link to get automatically redirected. Another very easy way of joining the channel would be simply go on Telegram and look for EXP-Invest IN, and you will automatically be led to my channel. Okay. Let's see. So Rafikul is asking what is primary indicator for swing trading? Again, Rafikul, there is no one right indicator. You have to find out what works for you. So I have been in the market for 10 years now, and I have gone the whole full circle. I have tried out hundreds of different indicators and come back to what I like to call the gateway indicators, RSI and moving averages, because I have seen the way RSI predicts or reads into the small changes in momentum which happen before a full on trend reversal happens is very beneficial. In fact, if you are more interested in my study of RSI, you should check out the video on RSI range shift, which is there on my YouTube channel. Again, on YouTube, just go and look for EXP-Invest and you'll see my channel. Within that, look for RSI range shift. If you're a technical analyst or if you have enthusiasm for the field, you will find that analysis pretty fun. So Rajiv has asked another question. He's asking, what should be the primary indicator to be clubbed with Fibonacci, any specific one? again, see, in the field of technical analysis, there is no one. Okay, there is always a cluster of multiple things which tell you the same story across different time frames, right? So I can tell you about what setup is working for me. I like to use 6 different time frames, 3 being the primary ones, and 3 being, just for the sake of reading into trend, like weekly and monthly is mostly to just get a sense of the broad trend, and 3 minute is just to, it's just there. Sometimes I find it fun to watch the 3 minute time frame, and 15 minutes, 75 minutes, and the daily is the main for me. On this, I like to set up my RSI. And again, I have unique periods for the RSI. I don't use the standard 14 period RSI. For more details, you can again watch any of my RSI videos. I use the RSI and I use 4+1 set of EMAs. 4+1 because the primary EMAs that I use are 20, 50, 100, and 200, and the +1 is the 500 EMA, which I sometimes use, sometimes don't use. And a combination of all these things with tools like trend lines and tools like Fibonacci retracement, like price patterns, candlestick analysis, all of them together give me enough intel into what is going to unfold and help me come up with highly profitable trade setups for myself and my clients. Ajay is asking a very loaded question. He's asking how to set up a trade setup, madam. That is the question, right? Just make sure that before you enter into a trade, you should know how much risk you're exposing your capital to in the market, and how much capital you want to allocate to that particular trade setup. So trade setup is nothing but knowing which stock you want to trade in, when you want to trade in, how much stop loss you're going to have, how much target you're going to have, and as a factor of support and stop loss and target, what will be your risk reward ratio. So this risk reward ratio, in my opinion, should always be at least 3, okay, for any trade setup to qualify to receive your capital. And make sure that you're properly then managing your active position. Make sure that you're using trailing stop losses. Make sure you know how much of your capital you want to allocate. So if you take care of your risk management and your capital management, you have a pretty good trade setup going up for you. Now, within this, what should be your entry point will depend on your analysis. Where will your stop loss lie will depend on your analysis. Where your target will lie will also depend on your analysis. And even after doing everything right, something called a whiplash can happen in the market, which can just graze everything to the ground, and then a lot of presence of mind is required to tread those kind of conditions in the market. All right. Okay, so I think with that, we are officially done with this session. Thank you so much for joining in. Wishing you all a very happy Independence Day. Thank you for taking time out on your holiday and attending this webinar. I really hope I was able to add some value to you. I will see you again on Thursday in the Let's Get Technical series, where I bring to you my past trade setups and we together do a post-mortem of it to see what we can learn out of our mistakes, so that we reinforce the good trade setups and we try to eliminate the bad practices in the trade setup. This post-mortem of past trade setups is the key to my success. It can be the key to yours too. So I will see you on Thursday. Thank you so much for joining in. Have a good day.